Hello, today we are going to talk about LIFO and what is LIFO. The cost of inventory is one of the biggest expenses for any business. Understanding how much money you spend on it is key to determining whether it makes sense for your company. In order to calculate the cost of inventory, you must know what type of inventory you hold. You can calculate the total value of your inventory by multiplying the quantity times the unit price. For example, if you have 100 units of product A costing $10 each, then the total value of your current inventory would be $1,000. Once you know the total value of your existing inventory, you can subtract that number from the total sales revenue to determine the amount of profit you made on those products. LIFO versus Fifo. While LTFO is an acronym for last in first out, Fifo stands for first in first out. The LIFO system is based on the concept that the most recent products will be sold first. Fifo is the opposite, as it believes that the oldest products will be sold first and utilizes those lower costs when calculating COGS. Most often, LIFO results in lower closing inventory and larger COGS. Fifo differs in that it leads in higher closing inventory and a lower COGS. LIFOs are more popular among companies with large inventories so they can reap the benefits from higher cash flows and lower tax rates when prices are rising. Fifos are more common because it is an internationally accepted accounting method and businesses typically want to sell older inventory first before bringing in newer stock. Benefits of LIFO. The most notable benefits of LIFO include cost savings. If the cost per unit of your product goes up over time, the LIFO method can help reduce your expenses. This is because applying older inventory costs to COGS before applying the latest costs will cause your profit margin increase. The higher your profit margins, the more money you'll make. Depending on your unique situation and finances, this can mean significant cost savings over time. Better visibility into your finances. The LIFO method allows you to see exactly where your company stands financially. By comparing your current inventory costs against current revenues, you'll be able to determine if you're profitable or not. This can help you avoid unnecessary losses and keep your business running smoothly. Positive customer experience. The LIFO approach gives you the opportunity to fulfill orders based on your most recent inventory costs. This means that you'll be providing your customers with a better overall experience. They'll get what they ordered faster and won't have to wait around for outdated inventory to arrive. When to use LIFO. LIFO might be a great choice if you operate in the United States and the prices of your inventory are decreasing or are likely to drop in the future. By choosing this strategy, you'll take advantage of the current market conditions and sell off older products before they lose value. LIFO is often used in retail stores and manufacturing businesses. LIFO examples. By looking through a few examples of LIFO in action, we can see what it would mean for your business if you went down this path. Example A. In January, Kelly's flower shop purchases 100 flowers for $25 each and 25 roses for $15 each. During the second quarter of the year, it buys 10 more flowers for $30 each and 15 more roses for $20 each. At the end of the year, it sells 30 more flowers for $40 each and 45 more roses for $25 each. It earns $1,000 profit during the first half of the year and loses $500 during the second half. If Kelly's flower shop uses LIFO, it will compute COGS based on the cost of the items it bought in March. Here is what the calculation would be. COGS 50 exotic flowers multiply $20, $1,000, plus 25 roses multiply $30, $750, equal $1,750. Example B. Andy's wood shop sells wooden figurines. Its business has been doing well so far, resulting in larger inventory order and better bulk pricing from its suppliers. Andy decides to take his entire stock of 30 wooden figurines to a local craft fair. He brings along 3 orders with him. Order 1. 5 wooden figures valued at $30 each. Order 2, 10 wooden figures valued at $25 each. Order 3, 15 wooden figures valued at $20 each. COGS, 10 figurines x $20 each, plus 5 figurine x $25 each, $200 plus $100, $300. Bottom line, the LIFO method reduces your profit margins, and in turn reduces your tax liability. Before you implement it though, understand that lower profit margin can be problematic if you're applying for credit or funding. In addition, LIFO is only allowed in the US, so if you're an international business, it'll not be an option. Frequently asked questions: what is LIFO? LIFO stands for last in first out. It refers to the amount by how much your business taxable income has been reduced due to the LIFO method. It shows you whether LIFO is worth it for the tax saving. Is LIFO legal? LIFO is only legal in the United States. Therefore, if you operate internationally, you should stick to the Fifo instead. How do I calculate my profit margins using LIFO? To calculate your profit margins using LIFO, follow these steps. 1. Determine the total cost of goods sold, COGS. 2. Multiply the COGS by the average unit price. 3. Add the resulting number to the beginning balance of the LIFO account. 4. Subtract the ending balance of the Lifo account from the beginning balance of the LIFO account. 5. Divide the difference between the two accounts by the total number of units produced. 6. Round down any decimal places. 7. Multiply the answer by 100 to get the percentage. 8. Use the following formula to determine your profit margin. Beginning balance A ending balance / beginning balance, multiply 100%. 9. For example, if you had a starting balance of $1,000 and an ending balance of $2,500, then your profit margin would be $2,500 minus $1,000, divided $1,000 multiply 100% equal 15%. 10. You may also use Excel to calculate your profit margins. Thank you for listening. Don't forget to subscribe and hit the bell.